Welcome, friends, to Alpha Beta Soup. I'm TXMC. Today will be part 4 of our multi-part series exploring economic downturns centered around the US. In the previous 3 episodes, we've been doing a massive deep dive to try to learn what US recessions look like. What do the official authorities look at? What else can we look at to get a more holistic approach? What do we think the current economy is doing, and is it heading for a recession? That has been the theme of the prior 3 videos, and I strongly recommend that if you haven't watched them, you go back and you start with part 1. All of the links will be in the description below, and each episode builds on the one before. So it's really important that you understand where we're starting out today. This has been a great series, so I really encourage you to watch it all if you haven't yet. And the next step for today is to move the conversation forward, to start including Bitcoin into our analysis, and try to understand how we think it is affected by what's going on in the economy and what that means for its price action. So we've got a few things to talk about today. Got some different charts to show you that you've never seen before, though you may be used to that if you've been watching this channel for a long time. We like to give perspectives that no one else is looking at, so don't go anywhere. If you enjoy my content, please subscribe to this channel, give it a thumbs up, share it with your friends. Make sure you also enable the bell icon so you're alerted to any new videos I put out. And where we'll start today is right here on your screen, the manufacturing PMIs. This chart might be familiar to you from a previous video in this series, and I want to bring it up to kind of lay the groundwork for what we're going to talk about today. So the PMI is one of the factors informing us about the likelihood of recession. There are numerous factors: the inversion of the 3-month 10-year yield curve, the contraction of PMIs, particularly below the 47 level as they are now at 46.9, as well as the contraction of the new orders aspect of manufacturing PMIs, and several of the other things we talked about in the previous videos that are beginning to soften. And the PMIs themselves are a really good indication of sentiment, and generally speaking, the market tends to follow the path and the fate of the PMIs. They tend to be intertwined with each other. And you can sort of see that here on the year-over-year change of the S&P overlaid with the PMIs. So the S&P is in blue, and it's a bit choppy, it's not perfect, but generally you can see that when the PMIs in black are expanding, and particularly when they are rising, equities tend to be performing well, and performing increasingly well as time goes by. But then as the PMIs begin to soften, as they start to downturn, and even when they get into contraction, that also tends to be a period of softness for the market, either a pullback or just a general accumulation period. Either way, price doesn't usually keep going up while the PMIs are going down or being negative broadly about the future. We have a bit of a divergence here in the present day, but this isn't a complete dislocation from the historical trend. This is just some volatility and some chop in this imperfect comparison. But it's clear that they share a meaningful relationship. This is Bitcoin. I don't even have to tell most of you, you can see the fractal and just recognize what this chart is. And I think there's a lot of misunderstanding about what drives Bitcoin's price cycles. There's a lot of lore built into its mythos, because over the years, it has developed a pretty remarkable symmetry from a cyclical perspective. It has these big waves and then these long bear markets, and these big waves and these long bear markets. They've been relatively uniformly spaced out, and they have a rhythm to them that Bitcoiners have come to be very familiar with, and many people actually rely on these patterns continuing into the future. Here is the S&P. The things that drive its movement also have a lot of mythos and misunderstanding, but what I'll show you today, and the case that I will make to you, is that what drives both of these markets are the same factors, and in most cases these markets go in the same direction, and they have since the beginning of price for Bitcoin. First, though, we need to mention the halvings. Many of you already know what this is, but a basic primer is that the Bitcoin protocol reduces its daily issuance amount every 210,000 blocks. Every new block is about 10 minutes apart, and as of today, each new block is issuing 6.25 Bitcoin. The initial issuance rate in the first epoch was 50 Bitcoin per block every 10 minutes. After the halving in 2012, issuance was cut in half to 25 for this era here. In 2016, we had another halving, and daily issuance was cut to 12.5, and that went through May of 2020. And after that halving, issuance was cut again to 6.25. When we have the next halving in approximately April or May of 2024, issuance will be cut in half once more down to 3.125 Bitcoin per block. And there's a lot of belief in Bitcoin circles that the halving itself is what allows Bitcoin to have such symmetrical price action. That we have these bear markets, then we get a halving, it cuts the issuance rate, which in people's minds means that supply is becoming more restricted. And then when we get a demand impulse, it shoves price up. Then we get a bear market, we get a halving, issuance is cut, demand pushes price, rinse, repeat, rinse, repeat. And that is a very strong idea in the mind of a lot of Bitcoiners. Now, interestingly, the S&P also has some curious things about it when we look through the exact same lens. These are the Bitcoin halvings. Here's the S&P with the Bitcoin halvings overlaid on top of it. Now, some people, when they see this, they immediately dismiss this analysis as part of what's called the multiple comparisons problem. The multiple comparisons problem is something that comes up in statistics, and basically it suggests that the more variables you throw into a model, the more likely you are to pull out irrelevant conclusions. The more likely you are to find spurious relationships between data points. But it's important to note here, we're not looking for correlation. We're not trying to explain that the halving affects the S&P. We're actually trying to prove the opposite, that the halving is relatively innocuous, but because of its placement, it gets credited with a lot of what is already being driven in the markets and the economy underneath. So here's the S&P, shaded by the halvings. And what's kind of odd is similarly, just like we have a bull cycle in the middle of an epoch and then a bear, and then a bull cycle and then a bear, and then another epoch starts and then a bull and a bear. Similarly, in the S&P, you see something the same. We had a halving, we had a bullish impulse, and then the market cools off. And then there's a halving, and then the S&P rips a bit, and then it cools off. Then there's a halving, and the market takes off, and then it cools off. So it's following a similar trend, similar to Bitcoin. But is the halving driving equities? No, absolutely not. But there is a relationship between the S&P and Bitcoin. So Bitcoin is in black on a year-over-year percent change, and the S&P is in blue. Now, clearly, they are not correlated one-to-one in a sense that every time Bitcoin moves 10%, the S&P moves 10%. There is a beta to them. Bitcoin moves on a larger percentage scale. It has more volatility. But when you look at it directionally, they're very similar. So here on the BTC chart on black, back 2013-14, this is the huge bull run, right? And this shoots all the way up to the 100x multiples. But during that period, look at the blue line. It's accelerating, right? Gains are improving in the S&P. And then as the Bitcoin bear market comes in, as the year-over-year change plummets back down to 2 or 3 or 4x, the S&P is seeing diminished year-over-year gains. Then there's this long bearish period for Bitcoin. And during that period, equities come down and find a bottom in year-over-year gains, and they slowly start eking higher as Bitcoin's floor is established and it starts putting in gently higher year-over-year gains. Then again, bull market, huge parabola and Bitcoin, broad gains in the market. Bear market for Bitcoin, the line comes back down, blue starts to fade lower. Even in the mid-cycle pump in 2019, which if we go back to the price chart is right here. This was in the summer of 2019. This was partially driven by some manipulation going on with the Plus token Ponzi. That was something going in Asia. They acquired like 1% of all Bitcoin supply at a period of time, and it really helped drive this squeeze during this point of the market. But even during that point, when you see Bitcoin right here pushing up higher on its year-over-year percent change, so is equities, right? And then we have the COVID crash down here. This is the COVID crash. But then again, the 2021 market follows a similar fractal. So you can see that the S&P and Bitcoin broadly in a year-over-year percent change perspective, they follow each other. The beta is there for Bitcoin. It moves much more, but in a directional sense, if you're just aiming the rudder of the boat, they go in the same broad direction. Here's the S&P, and then below is the manufacturing PMI that we have already established is pretty important for learning about where the market's going, where the economy's going. Here's the PMI, and we started in 2010, 2011, so that we have a similar perspective to Bitcoin, because the focus here is really Bitcoin. I'm showing you these pieces of the S&P because they help lay the context for what we're showing about Bitcoin. Similarly to the year-over-year change between Bitcoin and the S&P, the PMIs broadly follow bullish and bearishness in the market, right? We have established that. We saw that on this chart over here between the S&P and the PMIs on a rate of change basis. Here's just the PMI index by itself, and you can see bullish, bearish, oscillates up, market goes up, starts to cool down, market goes a little sideways, has a bit of a bearish period, PMIs begin to expand, market expands. PMIs contract, market goes sideways and chops for a long time. PMIs bottom out in COVID, so does the market. Everything screams higher. PMIs begin to contract, market contracts. So we can see the oscillation. It's kind of a roller coaster, up, down, up, down, up, down, and the market follows it as well. Here's a look, same PMIs, but with Bitcoin. And what do we see? We see a similarity, which you might think makes sense when we looked at this chart together of the rate of change being so similar. But it says something else when you really look at them on the chart together. Top of a bull market, high of PMIs, PMIs come down, bearish period for Bitcoin, PMIs expand, bullish period for Bitcoin, bear market, low PMIs, etc., over and over again. Peak of PMIs, peak of the market, low of PMIs, lows of the market, highs, highs. So the relationship is pretty stark. It's kind of hard to avoid it. But can we look at this in a different way? Why, yes. Why don't we bring in our halving comparison? So before anyone mentions the multiple comparisons problem, we are not suggesting that there is a correlative relationship between the halving and the PMIs. What I'm trying to show is the spurious credit applied to the halving itself for why Bitcoin's price does what it does. What I want to show you is that Bitcoin is connected to the economy, and you can see that through multiple lenses if you merely take the time to look. Isn't it strange that PMIs tend to be lower around the time of the halving, and then they expand into the bullish periods for Bitcoin? And that whenever we've had halvings, they have tended to be coincidentally near low periods for PMIs, near what I would call the trough of PMIs. The halving has arrived during that period every time. Now, I presented this to one of my friends who is a Bitcoiner. I think they were joking, but their first reaction was, well, I wouldn't put it past Satoshi to have orchestrated that kind of forethought. People actually think Satoshi was such a fucking wizard that he actually launched Bitcoin in a rhythmic pattern with the economy, that he launched it in such a way that it would have 4-year cycles that perfectly align with a mystical 4-year cycle in the equity markets and the economy, and that it isn't just a happenstance byproduct of when the protocol went live in January of 2009, which was just coincidentally a month or two before the bottom of the S&P. So when you look at Bitcoin and you look at the PMIs and you color them by the different halving epochs and you even draw the lines of where the halvings are, it shows a very interesting dynamic. And that dynamic, in my interpretation, is that the placement of the halvings is completely coincidental. It's an accident, and it happens to be the greatest accident in the history of Bitcoin marketing, because everyone believes the halving is driving price. But I contend that the economy and liquidity conditions and credit conditions and risk appetite broadly are what is driving Bitcoin's price cycles, just like they drive the equity cycles. And that the halving just happens to be one of the most conveniently located events anyone could have devised, because it doesn't explain why the PMIs would share a symmetry with the placement of the halvings other than it being pure coincidence, because PMI cycles have oscillated for decades. The PMI began in the middle 20th century. It didn't start changing its behavior just because of Bitcoin. Bitcoin slid right into an existing economic rhythm, and it has found itself following the same factors that drive equity markets. Let's look at another example. Maybe your head is spinning a little bit. You're trying to understand what it is I want to present. I'm trying to illustrate various forces that drive market conditions broadly and overlaying Bitcoin and its native mythology on top of those things to A, dispel that mythology, but also B, to emphasize that Bitcoin's fate is tied to the fate of the economy, broadly speaking. So let's keep going and maybe it'll start making sense to you. What we're looking at is Bitcoin at the top, and at the bottom is high yield corporate credit. And what I'm showing is an inverted percentile rank. So what a percentile rank does is it stretches out the metric that you're applying it to show you the extreme oscillation oscillations. It ranks the value of the yield in its historical range to show you when something is really high or really low relative to its norm. So what this represents in a way is equity risk premium, is risk appetite broadly. Higher value, more risk appetite, lower value, less appealing risk. That's the proxy way to look at this. And what you'll see, it follows Bitcoin's cycles really well. This is one of the first macro indicators that I ever chose to compare Bitcoin to. And it just leapt off the page at me, and it sent me down a long-term rabbit hole for the last year that I am now presenting the findings to you from. And I think that this is one of the clearest indications that Bitcoin is following the economy. Look at the lineup of this oscillation here. Look where the lows are. It's literally the lows of Bitcoin every single time. Look where the highs are. It's literally the peaks of the market every time. Let's continue with our exercise of applying the halvings. This is the same line, okay? So down here it's shown as a black line. I simply turned it into an area chart to make it more colorful. But what we did do is color it by the halvings and put these dotted lines in here, just like we did over here on the PMIs, right? That's what the colors mean, the different Bitcoin epochs. So we're looking at them again on here. And yes, high yield corporate credit has no effect on the halving. They are not aware of each other in any way whatsoever. But the halving is what gets all the credit. Whereas actual credit, corporate credit in this example, are telling you the fate of the economy, the near-term fate. Equity risk premium expands, risk appetite broadly expands into the bull. It contracts, Bitcoin falls. This is extremely consistent over time. And what you'll notice, just as we currently have contracting PMIs below 47, flashing a red signal, this value remains quite low. Even as we have Bitcoin ripping this morning up to near the year-to-date highs, we still show equity risk premium, our proxy for it through this lens, is still appearing to be relatively bearish conditions based on where it is in the past. And when we look at where it is, we haven't begun a real bullish impulse at any point while this remained quite low. Now it can accelerate, but for that to happen, we would probably need to see interest rate cuts, because what is partly driving this is the aggressive pace of rate hikes by the Federal Reserve. So that is what would help to bring this value up higher. And so until we see that, until we begin to see this softening to the upside, it's hard to see prolonged upside in Bitcoin's price because it has so consistently followed it throughout time. Let's keep going. At the top, we have the S&P 500. At the bottom, we have the 10-year Treasury. Now, what people don't often understand is that interest rates go up in bull markets. Interest rates don't go down during a bull market. They slowly rise as the economy continues to grow and perform. You can see that here on the chart. Here was a little bearish period. 10-year Treasury was at lows. The market begins to climb. Yields begin to climb. Yields begin to soften and turn down. The market kind of bowls over down into a bearish period, and that's the local low on yields. The market begins to expand. Yields begin to expand. Late 2018, the 10-year rolls over and it begins to plummet. And that is a period of real struggle for the equity market. It makes highs, then it comes back down and sets new lows. And we kind of have this expanding wedge on the S&P. This was during pretty much all of 2018 and 2019. Then we hit COVID, rates hit a low, they began to expand, and the market began to expand. That has been mostly the trend. And during this entire period, we had low inflation. So rising rates occurred gently for the most part. The Fed did try to raise a couple of times in here, but they did it at a much slower pace. But what happened in the beginning of 2022 was the Fed acknowledged that inflation was here for the first time in decades, and that they were going to have to take exorbitant measures to do something about it. So they began raising rates at an artificially fast pace, at a pace much quicker than the market was willing to handle. What ended up occurring is the historical relationship between these two broke. Yields went higher as the market sold off. This dynamic right here broke the long-term trend of yields up, market up. That relationship may come back and strengthen again, but it's not likely to be while we are still in an elevated inflation environment. Inflationary markets see bonds and stocks form a tighter correlation. Their prices form a tighter correlation. So when bond prices go down and stock prices go down together, that means the yields on those bonds are going up. When you sell a bond, the yield goes up. So when that relationship broke, this, which would have normally come down down during 2022 based on past relationships. Instead, it screamed higher as the market went lower. Here is Bitcoin with the same 10-year Treasury, and it follows the same relationship. Bitcoin bearish period, yields down. Yields rising, bullish period for Bitcoin. Bear market, declining yields. Elevating yields, bull market, same relationship. And then again, here in early 2022, right around where my red dot is, that's when the Fed said, we got a hike, boys. It's coming. It broke the stock bond correlation that had existed for 40 years, where they were counterparts to one another, and they both began to sell off at the same time. So in early 2022, whereas in the past we had seen the markets sell off and yields falling as growth expectations plummeted, instead, we got a Fed jacking rates up at one of the most aggressive paces in history, so yields exploded while the market sold off, and this relationship broke in half. Here is the same view. This is the 10-year Treasury. This is the 10-year Treasury, but I'm showing it in a percentile rank, which is exactly what we did over here for corporate credit. Same exact thing. And you see, it follows the cycles extremely closely. Isn't it weird that every halving has arrived at a relative local low for the 10-year Treasury? Every single one of them has arrived at a relative local low for the 10-year, at a relative low in growth expectations. And then as the market turned around, as yields began to push higher, Bitcoin pushed higher. Are you starting to see the pattern here? We've shown this now through multiple lenses. We've shown that the S&P and Bitcoin, generally speaking, have positive gains together and negative gains together. We've shown that the S&P and the PMIs follow each other in rate of change terms, in terms of expansion and contraction. That has an effect on the gains of the S&P on a year-over-year basis. We also showed that Bitcoin, likewise, because it has that relationship with the S&P, it too follows the PMIs in bullish and bearish cycles. We discovered that corporate credit does a similar thing. Equity risk premium expands into bullish periods for Bitcoin. It contracts in bearish periods, and likewise, this is happening in equities at the same time. Again, here looking at it with the 10-year Treasury yield. Through all of these analyses, the halving has appeared as a coincidental event. It just happens to appear at the perfect moment it is supposed to appear to create a bullish narrative. In a lot of ways, the market tends to conjure stories to justify what is already going on in the price action. And I strongly believe that the halving is one of those things. So from my perspective, going forward, I think that it has almost no impact whatsoever on the actual mechanics of price and bull-bear cycles. I do think that there is some narrative hype. I think some people will be excited because the halving is coming. More people will be talking about Bitcoin. That naturally might have a bullish impulse. Can't deny those things, right? Narratives can be quite powerful, but from purely mechanical perspective, I think it's very conveniently located. And when we look at PMIs, when we look at corporate credit, when we look at yields themselves, they follow Bitcoin's bull and bear cycles. Bitcoin follows their cycles. In fact, that's actually what's happening. Bitcoin was born into an existing economy. It is a monetary asset. It is a speculative asset. And so it slides right into the existing zeitgeist. It has its own narratives. It sometimes has idiosyncratic flows, things that are just going on in Bitcoin unique to it. But if the economy is not doing well, Bitcoin will not do well. If credit conditions are not improving, if liquidity conditions are not improving, Bitcoin will struggle along with equities, broadly speaking. So when we look at where the PMIs are, and we see that they are in a contractionary period that aligns heavily with past recessions, when we see the 3-month 10-year yield curve in deep contraction, and as we studied in the previous videos in depth, it is a stone-cold harbinger of a recession on the horizon. And then we lay that in with everything that we just talked about, this whirlwind of charts I just threw at you, explaining that Bitcoin follows the market, follows the economy. Then it suggests to me Bitcoin can't realistically expect to begin its next bull market until the economy starts to flash more green signals at us and fewer red signals. Might that happen in the next few months? Sure. The economy could start to turn around. All these metrics that we've looked at together in the prior videos that are currently softening, these things that lead us into recession that are currently in a drawdown while none of the others are, maybe they begin to turn around. Maybe they begin to grow. But things like real retail sales, which which contract mildly on the way into a recession, well, those things today are contracting heavily. And that's one of the leading indicators of where the economy is going. Real retail sales, real manufacturing sales, industrial production. Those are the things we focused on in the first couple of videos. So I remain extremely cautious about what the next few months bring. Perhaps the economy begins to turn higher. Perhaps we leave all of this behind us. That could happen, but there is copious historical evidence in support of my thesis that a recession is coming. And if a recession is coming, and if the market has set new lows in every single one of those recessions as we've explored in the past, then I have to be open-minded to the possibility that Bitcoin could set a new low, that it could break these November lows and completely shatter the 4-year cycle as it is known to most people. Because Bitcoin has never experienced a real recession. 2020 happened so quickly and it was artificially driven that we avoided a lot of the virtuous outcomes that happen at the end of a business cycle. All of the zombie companies stayed zombies. And rather than allow the business cycle to come to its natural conclusion, they injected hundreds of billions of dollars of liquidity into the market to avoid a depression because they had artificially shut down the economy. So 2020 in a lot of ways was not a real recession. It certainly didn't happen on its own. And largely speaking, Bitcoin has existed in a pro-liquidity, Fed-put type of environment. But where we are today is very different. We have high inflation. We've been dealing with it. Even if it has come down in rate of change terms, we're still on the tail end of a very wild inflationary impulse in the United States. Europe and the UK are still dealing with their inflation. And I know that everyone wants these lows to be in. And as we talked about in a video a couple weeks ago, Bitcoin shows that it has probably bottomed, right? All the on-chain indicators that would call bottom have done so. We broke below the 200-week moving average and came back above it. We went below the realized price and came back above it. We saw all of the other capitulative signals that we normally see. And the market is moving forward as if those 4-year cycles are still intact because it is carrying on with its own belief. It becomes a self-fulfilling prophecy. And it will probably continue to do that until something forces it to think differently. Some exogenous factor outside of Bitcoin, outside of the S&P directly happens, and it forces everyone to reassess what they thought the future holds. I believe that that event is coming. It's hard to know exactly when. I've maintained a belief that it would take the majority of this year to find out, that we won't know until later on in 2023. I know everyone's really excited because price has been pumping on the back of this BlackRock ETF news. That is an exciting morsel of information, but there have been a lot of ETF applications. They've all been denied so far. And I think people are in a lot of ways just hungry for a narrative of the week. They need something new to sink their teeth into, and this is a real juicy burger. But I'm not buying it yet because the overwhelming compendium of information suggests to me that we are not ready for the next bullish market to sustain itself. That doesn't mean we can't have a violent retrace, that we can't have a really exuberant secondary reaction in a bear market, which I think that this probably will be at the end of the day, because Bitcoin has never really started a bull market while PMIs were still contracting, let alone when they were this frickin' low. And that's just one of the numerous data points that I've shown you guys. So that is where we will leave it today. There's much more that we could say, but let's keep it succinct and let's save the rest for next time. Make sure you follow me right here on Twitter at TXMCTrades. This is my main account. I do not have a private Discord. I do not have a private Telegram. I will never ask you what assets you hold or ask you about your portfolio. I will never ask you to send me money for some weird reason. So if you find scammers out there, report and block them. It's just me, and today, not a single one of you is paying me a dime for this analysis. If you have questions or feedback for me, make sure to leave them in the comments below. I review them all before they're approved, and that's where we'll leave it. There's more that I could say, but I'll tee it up for the next video and we'll save it for a few days later this week. There's a lot of excitement on Twitter. There's an overwhelming amount of bullishness, but I am extremely cautious as price is now creeping up into the retracement levels. We'll probably talk about that more in the next video, maybe do some more actual technical analysis on the market. We'll see how that goes. As a final plug, if you enjoyed this, make sure you subscribe, please share my video and enable alerts. All of that helps me to grow this channel, and your engagement means everything to me. Now I will let you go. Make sure you get outside and touch some grass. Don't get too wrapped up in what's going on with Twitter's bullishness. Those people on there are crazy. Take care of yourselves, friends. Take care of each other, and we will chat in just a few more days. Cheers, everyone.